Good to be here again.
Pretty amazing numbers when you look at some of these movers. It's been earnings season. We see some great consumer stocks. What do you think? How the consumer's been doing in the markets?
So I think the reflection of consumer confidence in the spending has given good tailwinds to digital marketing companies, Google, Facebook, the pipelines for spending money and getting customers. So they're going to continue to be strong if we have a good holiday season.
Yeah, we talk about the digital strategies and all the things that come to fruition with this. You expect it to continue, and you mentioned the names like Google and Facebook.
Sure.
But when you're really looking at that, you're also looking at competition to those types of names too, right?
Sure, and also players that aren't the most obvious in terms of what consumers see as the pipelines for customer generation. So things that are like in the lead generation space. So those kind of companies that don't really get paid attention to, I think we need to focus.
QNST is one, right?
Sure. So QuinStreet is an example. So these are companies where they are the lifeblood, the pipeline to sell leads to companies, mortgage insurance, for-profit entities like Quicken, State Farm, Geico. Those companies, 80% or more of their customers don't come from advertising on Google or Facebook. They come from these lead generation companies, which most investors don't really know about. QuinStreet, as of today, is the publicly traded one. There's probably a half a dozen big players in the space. They've had a pretty rough year. They were overexposed in the higher ed market, but I think 2020 for QuinStreet will be a decent year for them.
It's interesting that you came up with this one, not one that we follow so closely, but what were some of your main points that you look at when you're picking the stock?
So again, the big industries that purchase leads from these companies. You've got mortgage, insurance, and for-profit education. You've got some ancillary things, but those are the big three. When a company is positioned to be well diversified and one or two of those go down, I think if the diversification is key in that industry, and as an example with QuinStreet, I think, again, they had a rough 2019. They had some not great exposure in higher ed, but they've refocused efforts within the insurance division in particular. So I think if you look at their trailing 12, the forward 12 is going to be a little bit better. So it's trading right now at a 20% discount to their 52-week high. So I'd keep an eye on that one.
Oh, that's a good one. Okay, so we'll watch that into 2020. What about Seco?
So again, another one that I don't think people pay a lot of attention to. This is a company that is, in my opinion, the best run. They've got the A-team executive crew running Career Education Corporation, so a for-profit school. Past 4 quarters, they've exceeded estimates. I think their playbook from both a student acquisition and a student outcome is one of, if not the best in the space. They're running a great shop, and yet they're trading, I think, at a 25% discount to their 52-week high. So that's an example where I think investors see a whole industry that has some challenges, for-profit education, so they see the industry as having an issue, so therefore they probably discount the star of the industry, and I think that's a mistake.
You said they also compete against some very popular names like University of Phoenix, right?
Now, they've got good competition, but they are well positioned to, they've been having a killer year, and yet they're still trading at a discount.
Can we talk about wearables for a second? Yes. I know the Google Fitbit story has been of interest to you. Wearables have been on the rise, no doubt, for Apple. Garmin is a great one for the runners. Do you think this makes sense for Google and Fitbit?
I am, again, first and foremost, I'm a huge fan of Google. Their core business, they are going to continue to be the leading search engine on earth, and they're making a ton of money. They're, what, $1,300 a share. But this acquisition, I don't think is going to be a home run for 2 reasons. One, their track record, they've bought in the past few years other manufacturer technology companies, HTC, they bought Nest. Both of those have not been home runs. And so this is another example where they go out and they acquire a device manufacturer. And if you look at what Fitbit is and was in the recent past, they've lost market share the past 2 years. So they're getting their butts kicked by Apple and by Samsung. They're, I think, under 6% of overall market share. So they're atrophying. They missed estimates last quarter. I mean, I'm not saying they're in trouble, but I'm really surprised that if Google wanted to get into this market, that they were the target.
Yeah, there's been a lot of criticism that Google just can't handle some of these hardware type competition.
I mean, is the third time's going to be a charm?
And what about a Google phone? Wasn't there a Google phone that
Pixel? So as
that was like an epic fail, right? Or was it
I think
great?
It's a killer product, but that was the HTC acquisition. They bought HTC to bolster Pixel, and now I think the Pixel is the 3rd biggest in North America, but globally, it's not even on the radar. So that's a good example of that acquisition was supposed to boost Pixel, and the Pixel's now still a fringe player. Yeah.
All right. Well, it was great for the Fitbit shareholders.
No kidding.
I mean, they loved that. It's great to see you. Thomas Donohoe, CEO of Level Agency. Thanks so much for coming on the show.